Hey everyone, it's no secret that the economy's got people on edge right now, and for good reason. Inflation is at its highest level in decades. The last time we saw numbers like this in the US was back in 1981, over 40 years ago. To tame this runaway inflation, the Federal Reserve is hiking interest rates at a pace we haven't seen in years. Many are convinced this is pushing us straight into a rough recession. You can already feel the effects. Companies are slowing down hiring, unemployment is creeping up, and people are tightening their belts, cutting back on non-essential spending. Businesses and individuals alike are worried about what's coming next. Just take a look at Google search trends. Searches for recession have spiked as people scramble to figure out how to prepare for what's ahead. So, how do you invest and protect your money during times like these? To answer that, let's turn to the wisdom of the Oracle of Omaha himself, Warren Buffett. At 95 years old, Buffett has lived through 18 recessions and built one of the greatest fortunes in history through smart investing. He's seen it all: market crashes, wars, pandemics, you name it, and still come out ahead. Let's dive into what Buffett says about investing during uncertain times like these. But first, if you want to become a smarter investor by learning from the world's greatest, hit that like button and subscribe to the channel. My goal is to help you build wealth by studying the best. Now, let's get started. Here's a classic Buffett quote that sets the stage. At any point in history, even when stocks were at their cheapest, you could find an impressive list of negative factors. In 1974, when stocks were screaming bargains, you could have written down all kinds of reasons why the future looked terrible. And at market tops, you can always list bullish factors. We don't panic. We don't pay attention to that noise. Our premise is that this country will do well over time, and businesses will do well. The Dow went from 66 to over 10,000 in the 20th century, despite wars, depressions, and crises. There are always problems, but there are also always opportunities, and in this country, opportunities have always won out. Buffett's point is clear: economic noise, whether it's inflation, rising rates, or recession fears, shouldn't dictate your investment decisions. He and his partner Charlie Munger don't sit around debating whether to buy a great business because of external conditions like a looming recession. They've never passed on a fantastic opportunity just because the economy looks shaky, nor have they bought mediocre companies just because the economic outlook seemed rosy. Their focus is on finding great businesses, period. This approach flies in the face of conventional investing wisdom. Most people try to game the market by predicting what the economy will do in the next 12 to 18 months. If they think the economy is going to boom, they load up on stocks. If they expect a recession, they sell everything and hide in cash. You see this all the time. Turn on any business news channel or scroll through YouTube, and you'll hear experts preaching this kind of market timing strategy. But here's the problem: it doesn't work. Buffett explains why with a simple two-part test for what should influence your investment decisions. For something to matter, it has to be 1. Important, and 2. Knowable. Economic predictions definitely pass the first part: they're important. Knowing the future of the economy would be a goldmine. Imagine selling home building or auto stocks right before a recession hits, when people stop buying houses and cars, then buying them back at rock bottom prices just as the economy recovers. You'd make a fortune and be hailed as the next investing legend. But here's where it falls apart: economic predictions fail the second part of Buffett's test: they're not knowable. Nobody, not even Buffett after nearly a century of experience, has met anyone who can consistently and accurately predict the economy. Despite what the pundits claim, the economy is just too complex. It's not a simple equation like x plus y equals z. It's more like a calculus problem with thousands of variables: global trade, consumer behavior, government policies, all interacting in unpredictable ways. We've seen this recently with events in one country rippling across the globe, making reliable forecasts nearly impossible. This unknowability is the first reason why betting on economic predictions is a losing game. But there's a second, equally important reason: the best time to buy stocks is often when everyone else is panicking. When the economic outlook is bright, stocks are usually expensive, meaning your future returns will likely be lower. Conversely, when the economy looks grim and people are selling in droves, stocks get cheaper, setting you up for higher returns. Legendary investor Howard Marks illustrates this with a diagram showing how the stock market cycles through emotions. When investors are optimistic, excited, or even euphoric, they bid up stock prices, sometimes to unsustainable levels. This is when stocks are most expensive and future returns are lowest. It's also the point of maximum financial risk. As Buffett says, you pay a high price in the stock market for a cheery consensus. Then, when the economy turns and stocks start to fall, investor sentiment shifts from denial to anxiety, fear, and eventually panic. At the bottom, when investors hit capitulation or despondency and give up on stocks entirely, prices are at their cheapest. This is the ultimate buying opportunity for those who can stay calm. As the economy recovers, sentiment shifts back to hope, relief, and optimism, and the cycle starts over. Mark's diagram matches real market behavior. Look at the stock market from 2003 to 2013, and you'll see the same pattern of ups and downs driven by investor emotions. So, if we shouldn't rely on economic predictions, what should we do? Based on Buffett's teachings, here are 3 actionable strategies to make money during a recession. First, focus on microeconomics, not macroeconomics. Instead of worrying about the broader economy, zoom in on individual businesses and industries. Ask questions like, is this company gaining or losing market share? Who are the major players in its industry? Does it have pricing power? These factors are far easier to analyze and predict than what the entire economy will do. A great business with strong fundamentals can thrive even in a recession, and that's where you should focus your attention. Second, embrace dollar cost averaging. This strategy involves investing a fixed amount of money into the market at regular intervals, say, every month, regardless of whether stocks are up or down. By doing this, you avoid trying to time the market and benefit from buying more shares when prices are low and fewer when prices are high. Jack Bogle, the founder of Vanguard, swore by this approach. He advised investors to ignore economic noise, keep investing consistently, and check their account balance when they're ready to retire. It's simple, disciplined, and effective. Third, adopt a long-term perspective. In the short term, stock prices are driven by emotions and economic headlines. But over the long haul, they're determined by a company's fundamentals, its ability to generate cash flow. When people are scared about the economy, stock prices often dip, creating opportunities for patient investors. As Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. If you buy quality businesses at bargain prices during a recession and hold them for years, you're likely to see strong returns. So, there you have it, Warren Buffett's blueprint for making money during a recession. Ignore the economic noise, focus on great businesses, invest consistently, and think long term. If you found this helpful, please like the video and subscribe to the channel. Stay smart, stay safe, and let's keep building wealth together. Until next time, keep investing wisely.